Next right here, watch out for portfolio bombs. If you own an ETF that tracks a sector like technology, you probably expect your investment to actually have a similar return to that sector. Imagine that. But lately there's been trouble in ETF land with exchange-traded notes like the TVIX plunging as the VIX actually rose. So what other exchange-traded products are moving in all directions? We've got the worst 5 ETFs, exchange-traded products out there. We're joined now by Tom Lydon, president of Global Trends Investments, to count us down, the biggest offenders that may in fact be lurking in your portfolio. Hopefully not. Tom, it's always good to see you.
Hi, Melissa.
We want to go in reverse and sort of track down to the worst one. So let's start off here with what?
Well, in going over this, it's important to understand that on a given day-to-day basis, we might see different numbers. But there's actually one, GWO, which is a Credit Suisse Elements ETF, which is at a discount about 19%. So there's actually a buying opportunity for those that are in there, but it's also important to understand you got to lift up the hood and know what's underneath from time to time. But when you really get into the problems, as we count down, the long platinum UBS ETN, again, part of the problem here, as we had with the TVIX, is the issuer no longer issue additional shares. So then we get into a situation where these ETNs or ETPs start trading like closed-end funds.
Right,
it's
and
a
so
supply and demand issue.
That's why, Tom, it's very important to actually, I mean, if you're going to invest in a platinum ETF and expect that ETP, I should say, to track platinum, you want to make sure it's actually backed by physical assets like the GLD with gold, platinum, the physical, and there are ETFs that do that.
Well, they do, and in the case here, we actually have a couple that are ETFs, which are actually backed by stocks, but are also trading at premium as well. So we've got one in a municipal bond ETF put out by Columbia, but in fact, it's actively traded. Part of it is the supply and demand issue, and the fact that it is actively traded, and the fact that the assets in this ETF are very, very small, hence the premium.
Right.
And then finally, there's by market vectors, there's a China ETF, which is trying to emulate the A-shares market in China, which, as we know, we hear it's not a market. We can't. So they try to do the best that they can, but that's also trading as a premium.
So let's be clear, when you say a 10% premium, that means it's trading 10% higher at a 10% more cost to you. As
then the
opposed
indicative
to
value.
Right.
So, and the key is with ETFs, and I'm always looking for chinks in the armor like you folks are, but you can go on to any brokerage system and just put a .iv after the ticker symbol, and you'll see the underlying indicative value, the true value of the underlying index, compared to the current price, and it's really easy to see if it's trading in line or a discount or a premium.
And then the number one in terms of the worst offender is, no surprise, a natural gas ETP.
Right. And it's not as though it's a very individual sector. Here's another case where the folks at Barclays iPath decided not to issue new shares. They didn't want more exposure to this area. And then as the market's moving, there's more demand, more people pile on, and we're in a situation where we've got over a 50% premium. Very similar to what we had with TVIX last week. But that eventually settled. As you see, we'll eventually see this settle as well. But people who came on not understanding that they had this type of exposure obviously got burnt.
Hey, Tom, talking about both the ETN versus ETF, just again, make this clear. And what's the obligation of the issuer? So the TVIX was highly, choreographed. What Credit Suisse did not do, which was issue new shares. Until then, they let the word out that they were going to. And does the SEC have to spend more time looking at this? And again, letting the word out that you're going to issue new shares before actually doing it, to me, seems like a situation where some people had information and other people did not. So
that's
there's a lot of issues here.
Timmy, it's a great question, and I imagine with all the attention that it's got, that the SEC would probably be looking at this. And
I hope so.
And we're in a situation here where, hey, we've got $1.4 trillion in ETFs, 1,400 ETFs. Yeah. For the most part, it's been pretty clean. But we start to see a bruise from time to time. It's collectively our obligation to talk about it. The fact that they didn't want to issue new shares, it's completely their right. And if you look at their prospectus, they're saying this is a trading vehicle. expect to lose all your money. So they've done everything from a foreclosure standpoint, but as we saw volatility hit 5-year lows, obviously there was some demand from a hedge perspective, and being one of the largest out there, naturally money flowed.
Taking a look at some of these other ETFs, Tom, are the volumes very light? I mean, are investors aware of the fact that they may be investing in a product that doesn't actually track what they think they're tracking?
Well, not always. I mean, here's a situation with China, for example. You're actually not buying those China A shares because you can't get a hold of them. What they're doing is they're using derivatives, using the Chinese index to try to replicate it as closely as possible. Does that mean it's not worth the 6% premium? Maybe so, because you can get into that market. However, as you look at most of them, and the assets that are in there, volume is all under $50 million. I like to look at an ETF that's got liquidity over $100 million, at least to start, and most of the largest ones out there, and as you folks talk about ETFs on a regular basis, that's really where investors are looking for market representation, and most important, a tight bid and ask spread when you're looking at it from a liquidity standpoint.
But if you have a big thematic thing like China, the CAF, which I've traded plenty of times myself, I mean, basically the thing trades like 100 to 150,000 shares a day. That's not, I wouldn't say, it's like not too hot, not too cold. That's where a lot of hedge funds can start to live and roam and find inefficiencies and technicalities like Tim's talking about. I mean, you can't walk into these things not knowing who's in the woods hunting with you. I mean, this is a very serious situation, and I think that people are finally getting their eyes open to that.
You're absolutely right. So more than ever, it's important to do your homework. And just because ETFs are easy to invest in and you're able to access markets that 5 years ago the average investor didn't have easy access to, it doesn't mean that just jump in when you see an opportunity.
All right. Tom, thanks a lot for joining us.
Yeah,
Tom
nice seeing you,
Wyden
folks.
of ETFtrends.com.